A big common dilemma for every investor, whether you are just starting out or if you have been investing for a while already, is this: which should I go with, ETFs or stocks? So, most people have no idea which is suitable for them, and they decide not based on what they want, but based on what they saw online, what other people say, or what a friend tells them. And almost nobody makes this decision by comparing the pros and cons of both sides, of having an actual understanding. And that's probably why so many people end up staying stuck. Or worse still, they don't invest at all because they think it is too complicated. And so I have spent the last 7 days researching and comparing both sides to give you a comprehensive but yet simple breakdown and help you to get an answer for your portfolio in the next 12 minutes. And by the end of this video, you will have a clear idea on which one suits you the best. So let's get started. Now, let's start off by understanding what is an ETF. So, ETF, in short, it is known as an exchange traded fund. Now, you might have come across other terms before, for example, like unit trust or a basket of stocks or a basket of diversified stocks. So, most of it refers to exchange traded fund. And if it sounds too complicated for you, forget about the name. Here's what it actually means. So, one purchase of an ETF, it gives you instant ownership of hundreds or thousands of companies. For example, there's this ETF called VWRA. When you buy one single unit of that ETF stock, basically what is happening is that you own a slice of 3,800 companies worldwide. So you don't actually pick the companies by yourself. So when you buy the ETFs, these ETFs automatically picks them for you, right? So you don't have to do anything else other than setting your buys and adding to it regularly over time and let it grow. That is how compounding works. And it is very low cost, but more important, it is low maintenance. You don't have to worry about finding out whether is this stock good, is this stock bad, because the ETFs have already done the work for you. And from day one, you are automatically highly diversified. So, in the case of very huge market volatility, because the risk is being spread out, you will not experience very high volatility as well when you invest in an ETF. Now, on the other hand, what do you have? You have stock picking, right? So, in this case, you are investing in individual stocks, and you, as an investor, you are deciding what companies you want to buy to your portfolio. And it sounds very exciting, right? Like it's like you going to a shopping mall and you choosing exactly what you want. And it can be. But here is what most people underestimate: it requires real work. What do I mean by that? You need to research the business and understand the business. For example, what does it do? How does it make money? Is it growing every single year and producing cash flow every single year? Right? And this means you need to follow through on a company's earnings report every quarter, follow what they are doing, and also track their competitors and see how they are faring against them. So at the same time, you also need to make a call on whether the price is fair to value them. Is it cheap, or relative to the market, is it expensive? What is the business actually worth? And the hardest part of this is that you need to have conviction. Because you are investing in individual stocks, the volatility is higher, right? When you need to have high conviction when the price drops, when everyone around you is panicking. And it is easier said than done. So it's not as passive as an ETF, it is an active commitment. And so when you compare the risk profile of both of them, on ETF, you are spread across hundreds of companies. If, let's say, worst case scenario, one company collapse, you will barely feel it because it's like one egg crack, but you still have most of the eggs in that basket as well. Whereas for stocks, generally speaking, you will not have your portfolio full of like 100 or 200 stocks. In fact, if you do have that, you are better off buying an ETF. And generally, when you're picking individual stocks, your portfolio is definitely a little bit more concentrated, probably within the range of 15 to 20 stocks. And if you have one company that collapses, it will actually be detrimental to your portfolio. You will feel a much more bigger hit as compared to you investing in an ETF. With a difference in the risk profile, the potential upside, there is also a difference. So for ETF, because it is less volatile, the level of returns that you will get is definitely much more lesser. So for example, the S&P 500, on average for the past 10 years, they return about 12 to 13% per year. So it's not that bad. Imagine a portfolio growing at that amount every single year. And if you let it compound on a long period, you will still be pretty well off. Now, whereas for stocks, if you pick the good, high quality companies, you can actually significantly outperform the market. Think about that for a second. If you select the good companies and you outperform the market every single year, this means for a 10-year period, your returns compounded will definitely be higher or even double than you investing in the ETF. And of course, that comes with higher volatility as well. And that's the reason why you got to have more conviction and confidence in the companies that you select. So you've heard of the risk involved for both ETFs and stock as well as the difference in a potential upside. But you might be wondering, okay, so I understand both, but how do I decide what is right for myself? Now, I have come up with these three questions that will help you to understand which one suits you better, right? And you want to answer them honestly. And remember that there is no right answer. There is only the right answer for yourself. And every one of us will have a different answer. Now, the first question is this: how much time can you realistically commit to researching companies and following up on companies that you have invested in? Now, if your answer is, let's say, 1 to 2 hours a week or less, then perhaps ETF are likely the right starting point for you. Now, why do I say that? Because stock picking requires a lot of research to build up your conviction and confidence. And it is much more closer to like a part time job. But if you enjoy that kind of research and you find it genuinely interesting to learn how companies make money, how they stand amongst their competitors, and how they are going to fare in the long run, then stock picking might be a potential route for you instead. And question two, now this is a big one and an important one. How would you honestly react if your portfolio drops 30% overnight? Okay, now this is an honest question, so make sure you answer that honestly. Now, everyone will say, I will just hold until it really happens. Now, ETFs will make it easier to hold because you know that you are not just putting your money into 5 to 10 companies. You are putting it to a whole basket of stocks, hundreds, thousands of company, and you're basically putting your money and betting that the whole market recovers. And however, with individual stocks, a 30% drop might mean that the business is actually broken and not just cheap. And you might also be faced with the decision to ask yourself, should I sell this stock for a loss and rotate my money? And your ability to tell the difference actually requires knowledge and experience in the stock market that most beginner investors do not have yet. And question three is that, do you have a genuine view or interest on specific companies or sector? Or does the whole market, the whole idea of investing feel scary or unfamiliar to you? Now, for example, if you genuinely follow tech companies, for example, you understand what Nvidia does, you understand what Amazon does, or you believe in the AI infrastructure built up in that long term, that conviction that you have is a starting point for investing in individual stocks. However, if everything feels equally foreign to you and you just want like this one-stop shop for you to invest, then probably that is a sign that you're not ready to invest in individual stocks yet. And that is completely fine because ETFs were built exactly for that. So these three questions and with your three answers will tell you exactly where you fit. Now, here's what most people don't realize. And actually, it is not a battle of ETFs versus stocks, right? Actually, the most common structure among experienced investors, people that have been investing in many, many years, is ETFs as the core of their portfolio and individual stocks as what I call the satellite. So, by core portfolio, what am I referring to? I am referring to your foundation, right? Low cost, diversified, and compounding quietly in the background. Whereas satellite is your conviction play. This is where your individual stocks come in, right? Companies that you have researched, sectors that you believe in, and have very high conviction and confidence in. So having this core of ETFs actually protects you when your satellite investments, which is the individual stocks, might potentially go wrong, right? So the satellite will give you the upside when your conviction is there. So neither will actually cancel the other out. They work together. So when we invest, remember that it is always about finding the right balance that suits you rather than just choosing to grow either of one extreme. Now, I want to end off this video by sharing with you a common mistakes that I see many investors make. Now, most investors get stuck at this question, right? Should I invest in ETFs or should I invest in stocks? But remember what I shared earlier, it's not about an either or, it can be a combination of both. But because they are stuck at that question, that paralysis actually costs them more than making the wrong choice, right? The worst decision that you can make for your portfolio is actually no decision. And when you're sitting on cash, waiting to figure out which one is better, that itself is a decision, just that it is not a good decision. Now, if I could give you an advice, if you are starting out, always go with ETF first. And not because stocks are bad, but it's because ETFs actually gets your money into the market immediately. And in the long run, your time in the market matters more than timing the market because ETFs gives you the immediate exposure, built-in diversification, and minimal volatility, which works especially for newer investors, right? Better to be in the market earlier than later. So ETFs lowers the barrier. You don't need to know everything. You just need to start. And then as you build more knowledge and experience in investing, right? That is where you start to move and diversify a bit of a portfolio to individual stocks, where you develop conviction, you read more about companies, right? And that's where you start to look into which stocks might potentially give you higher returns. And a very good starting point if you're interested in stock picking, right? Individual stocks is the Magnificent Seven. So these are companies like Apple, Microsoft, Nvidia, Amazon, Meta, Google, or Tesla. So these are businesses that most people already use and you probably are using on a day-to-day and understand at a surface level. So they are not safe in a sense that they can't drop. They absolutely can. But they are well covered, well researched, and a very good place to start developing your stock picking instinct without going into the deep end immediately. So at the end of the day, the goal isn't like to pick some obscure company or to pick perfectly. The goal is to continuously get started first, get your foot into the door into investing, and to build knowledge through experience, right? And the market will actually reward the investor who start immediately, stay consistent, and keep learning, and not the ones that wait for the perfect moment and end up not investing at all. That's all that I have for you, and I hope that you have taken a lot of value from this video looking at both ETFs and stocks and finding that right balance for your portfolio. So if you do enjoy this video, I would really appreciate if you could like and subscribe down below. It would really help me to create more of such content for you. And I'll see you in the next one.